interest arbitrage, covered interest arbitrage. And arbitrage is about making free money with no risk taking. It's just like a pick up the money on the table and by taking advantage of the prices in different market. So in the covered interest arbitrage, definitely we're gonna take advantage of the interest differential among two countries or two regions. So let's say we have a United States and we have the Eurozone. And if US interest is 2% and Eurozone is 3%, then you will see we should invest in the Eurozone and not invest in the US zone, right? Because right here is where we can make more money in terms of percentage. However, we have to consider the exchange rate risk. All right. Although you can make an extra 1% by investing in Eurozone, but if the euro depreciate by the time you claim your interest and principals, then you would lose money. And how can you lock in that profit? You have to consider the future exchange rate and the current exchange rate. Okay, so you have to consider the current exchange rate, which is the spot rate, right? We have learned spot rate before. And the future exchange rate is not really certain, okay? So if it is coming from your expectation, then this is not certain. But if it comes from a certain financial product, in this chapter, we're going to learn forward, which is a product, and this is coming with a certainty. Okay, so the exchange we are doing here is we are going to convert dollar to euros with the current spot rate, and then we invest in the eurozone to make the interest rate difference, and we hope that this forward rate, not the future rate in our mind, hopefully it will give us some nice return, or at least don't eat up our profit from interest. So what is a forward? The forward is a contract, okay? It's a contract between two parties. They agree to buy or sell an asset today, and then the price is agreed upon today, but the delivery of the product and the payment of the product will take place in the future. In the contract, in a forward contract, the assets could be a stock, could be a commodity like oil, agriculture products. It can also be foreign currencies. And forward contract generally tend to be large in size. Is denominated by financial institutions, governments, and multinational corporations. So just a small individual traders like you and me, we cannot really use the forward to hedge the risk. A more available product to us as individual traders would be futures, which is more standardized and cost less to trade. But forward is usually coming with a large size and not as standardized. Anyways, forward is set up today, a contract signed today, and the payment and the delivery of products will be made in the future. Here are some terminologies. We have a forward rate, which is the exchange rate in the forward contract. Long, short forward positions. Basically, if you are buying a product, buying the currency in the forward contract, you're taking a long position. And today, if you sign a contract and make a commitment to sell foreign currencies in the future, then you are having a short forward position. The forward rate comes with American terms, which is a dollar price per currency. It can also come in the format of a cross exchange rate. You also need to know what is a forward premium. So forward premium is the amount of appreciation or depreciation embedded in the forward contract. There's also swap transactions. We're not covering that in this chapter. Rather, we're taking the arbitrage opportunities involved with the forward product. So let me just emphasize on forward premium. Let's say in this example, we have euros and dollars, and the forward rate will be, for example, $1.5 per euro. And this is some number we can see today, and we can sign a contract with. And the spot rate today is, let's say, $1.2 per euro. If you invest in the Eurozone, then your forward premium would be $1.5, which is a forward rate, minus $1.2, which is a spot rate, divided by the spot rate. So this is the formula, which is a forward minus spot divided by spot, and this will be 25%. Okay, so that means according to the forward rate that is provided today, we know that in the future the exchange rate of euros will appreciate to $1.5 from $1.2 today, and that is 25% appreciation of the euro. That's what we know today from the forward contract. And again, combined with the interest rate difference, not only can you make an extra 1% from the interest rate difference, but also you can get a 25% return from the euro appreciation. All right, so definitely the money should come from US and invest in the Eurozone. And now let's have another example. What about if the forward rate, instead of 1.5, it is actually 0.9, okay, $0.9. And then based on this contract, you can calculate the forward premium, and this will be a negative 25%. So if that's the case, then you will see in this case euro appreciates, euro depreciate and dollar appreciate. All right, so although if you invest in the Eurozone, you can make 1% extra return, but the depreciation of euros will eat up 25% of your revenue. You should keep your money home in the US, or the Europeans will invest in the US just to take advantage of the appreciation of US dollars against their currency, despite that the US interest is lower than the euro interest. Because for the Europeans, if this is the case, the appreciation of a dollar they get outweigh the lower interest, relatively lower interest in the United States. And here is a very important thing you need to remember. The forward contract is not necessarily due in a year. It could be due in 1 month, 3 months, 6, 9, 12 months. It has different maturities. It could be due, let's say, 301 days. It really depends on the parties who are negotiating the forward contract. With that being said, your forward premium should be a standardized number. Right here, your forward contract lasts for 180 days or half a year. Then in this case, it's this number, 6 months forward. This is a spot rate. So when you calculate the forward premium, you use the 6 month forward rate minus the spot rate divided by the spot rate. And this is a 6 month holding return if you sign the forward today. If it is 6 months, then to get the forward premium, you have to know that the forward premium has to be annualized. So this has to be annualized, which means if the rate here is a 6 month rate, then you will need to multiply the number by 2. And if this is a 3 month forward rate, you will need to multiply it by 4, because there are 4 quarters in a year. If it is a 1 month forward, then you will need to multiply the number by 12. So don't forget to annualize. The interest rate here and here are always an annual rate. That is a convention in the financial industry. Whenever there's an interest provided to you, although this product only lasts for 3 months, but the interest rate they give you is not a 3 month rate, is an annual rate. Okay, the number must be multiplied by 4 if this is a quarter long product, like a CD you put in a bank. Okay, so these are all annual rates. So if you want to make an apple to apple comparison, you compare the interest rate difference and compare to the forward premium. This forward premium has to be annualized according to its time to maturity. And once again, when you sign a forward contract, all the numbers are already known today based on today's quotes on the exchange board. Okay, so if you sign a forward contract, you can buy British pound at 1.9593 6 months later. And today you can also buy the British pound at $1.97 per pound 1 month later. That's how the game is played. And this comes with a certainty. We don't need to worry about what the future macroeconomic condition gonna be in US and in UK. We don't have to worry about the inflation announcement by the central banks or the interest or any other factors that might determine the exchange rate. As long as we enter into a forward contract, we know we locked ourselves in a rate that will certainly happen in the future. So if you take a long forward position, then you know that you have to fulfill the contract. That's the law. When you make yourself in a forward position, let's say in a long position, you made a commitment to buy 10,000 pounds 6 months later at a rate of 1.9593. Okay, if you are a arbitrager and you want to make some money, then you want to, when you purchase the 10,000 pounds, you want to sell it right away, hopefully to lock in some profit. If the pound rate 6 months later is greater than the forward rate you will get, then you will make money. For example, if the exchange rate, which is a spot rate 6 months later, we're not talking about today, it's a spot rate 6 months later, and the spot rate is for immediate transaction. If that rate is $2.1, that means you can buy at 1.9593 and then sell at a $2.1. So that's a profit for you. But what about if the spot rate is against your favor, against your fortune? Then the spot rate turned out to be $1.9 per pound. You still have to fulfill the contract you signed 6 months earlier. You still have to pay $1.9593 per pound. And then with that 10,000 pounds, you are not spending it for a vacation in UK or buy yourself a Rolls Royce. You are a speculator, you are a trader, you will need to clear your position. After you buy the 10,000 pounds, you will have to sell it at the prevailing market price, which is the spot rate 6 months later. If the spot rate 6 months later is 1.9, then you will have to sell it at 1.9. And if you buy at 1.9593 and sell at 1.9, you have a loss. So just to realize risk there, okay? So if you want to buy at the forward rate and then sell at the spot rate, you know spot rate comes with uncertainty, and that could be a loss for you. If you take the short position, it will be opposite. Short position means you will sell at a certain rate. If the spot rate at the time of maturity is greater than your forward rate, then you will need to buy at a greater rate at the spot rate and sell at the lower forward rate. Then you would have a loss. So all of these are loss. So this is a payoff and these are loss. And if the spot rate is lower, then you can sell at a higher forward rate, which you already agreed on 6 months earlier, and then you just buy at a lower spot rate to clear your position, and then that is how you make a profit. Okay, so this is a little bit different from the interest here we only compare the forward rate 160 days later and the spot rate 160 days later. So if in your expectation, okay, let's say if this is you, a happy trader, if in your mind you are thinking the spot rate 180 days later is going to be $1.2 per pound, all right, and then in the market the spot rate is $1.1 per pound. Okay, so what do you need to do? You are thinking it's going to be 1.2, and now and the market is thinking it's 1.1, and you're pretty sure you are right, although that's your own reality, not the market reality. Then what you would do, you want to take advantage of this low price, buy at that, and so you could sell at a higher price in the future. And there could be two situations in the future. What about if you are right? Okay, I say you are right. Then 180 days later, the spot rate is $1.2 per euro, per pound. Then you will buy, fulfill the forward contract and buy at 1.1. Okay, so you pay $1.1 for a pound, and then you will sell the pound you just purchased at the prevailing spot rate. So you could make $0.1 per pound. And this again is in your expectation. Okay, so that's your expected gain. So what about if you are wrong? If you are wrong, then the spot rate 180 days later, instead of being 1.2, is $0.9 per pound. Okay, then you still have to fulfill the forward contract you just previously commit yourself in. So you still have to pay $1.1 per pound from the forward contract. So that will not change. What is changing is when you sell the pound you purchased, you can only get $0.9 per pound, and then you will have a negative $0.2 per pound losses. Okay, so from this example, you can see that you could be right about guessing the future rate. You could be wrong, but the forward rate is currently available. If you make a commitment, no matter you are right or wrong, you always have to fulfill the contract and pay $1.1 per pound to buy the pound. Okay, so now we have a different currency, and this time the forward rate for Japanese yen, let's say in 90 days, is $0.01 per yen. And again, you are a trader, and in your perception, the spot rate 90 days later is going to be $0.008 per yen. Okay, so based on your perception, the rational choice for you is to buy at a $0.008, which you hope to be true, and then sell at the $0.01 per yen. So what you will do is you will decide to take a short position. You will decide to sell at $0.01 per yen. Okay, so there are only two situations. If you are right, let's say the spot rate is $0.008, so you will need to pay $0.008 per yen, and then according to the forward, you sell at $0.01 per yen, and then make a profit of $0.002 per yen. Okay, so you're happy. And what about if you are wrong? I mean, you are wrong and also you are making a loss. Let's say if the spot rate is 0.011, okay, 0.011, and you still have to, okay, to sell at 0.01, and then the spot rate is 0.0011, and that's what you need to pay to get the 1 yen in order to fulfill this forward contract, and then you would be making a loss of a $0.001 per yen. Okay, so this is how you make a profit. Of course, if your guess is right, you could make money. If your guess is wrong, you could lose money. And the spot rate can also be 0.007, which is also good for you. It just means you were conservative when guessing this 0.008, and then in that case you would be making more money. Okay, but no matter what the future spot rate is going to be, or whether you're right or wrong about guessing the future, when you sign a forward contract and take a short position, you always have to sell at the forward rate and receive $0.01 per Japanese yen. The only difference is if you are right, you would be making money. If you are wrong, then you would be losing money. And then get back to our covered interest arbitrage. So covered interest arbitrage deal with a forward. So I just spent a lot of time to define forward and how to play with forward. And in the covered interest arbitrage, we will capitalize on the interest rate differential between two countries, and that one we have covered earlier. So this is the US rate and the euro rate I mentioned earlier. I hope you still remember. Okay, and then you will use the forward contract to cover your exchange rate risk. So you are not making guess about the future rate. Instead, you sign a forward contract today to lock in a future rate. In that case, you are not exposed to any risk at all because every number involved with the trading is known to you today. Okay, so there's no risk, and you need to consider the risk premium of the forward contract. If it is a negative number, you would call it a forward discount. So right here is the available information to us. The US interest is 3.4%, the Eurozone interest is 0.6%, and the spot rate is this, the forward rate is that. What is your best investment strategy? Assuming that you are not making your own commitment, investing out of your own pocket, but you can play the trade at the size of $5 million. The forward is a 6 months forward. So what do you need to do? The easiest thing for you to make a decision is to compare how much your dollar would make for you if it stay home and make the US interest. Let's see, if the $1 stays home, you would make the US interest. And if you invest the $1 in another country, in that case in the Eurozone, then this $1 will be converted to euros based on a spot rate. And then after it converted to euros, you can earn the euro rate, right? And then you will have the proceeds and principal and interest, and then you will need to convert it back to US dollars. So you will multiply the euros you're going to sell by the forward rate. So you're going to make that comparison. So you are comparing 1 plus US rate with forward over spot times 1 plus the euro interest rate. And let's see whichever is greater. And in that case, the US rate is 3.4%, and the euro rate is 4.6%. Okay, the spot rate is 1.3, and the forward is 1.3. The spot rate is 1.2730. Okay, the thing is, this is a 6 month forward contract, and the interest rate is always given as annual rate, which means you need to divide the annual rate by 2 in order to make a 6-month rate to match the maturity of the forward. Okay, so essentially you are making the comparison of these two sides. The calculation will tell us the right hand side is a greater, so this side is a greater. It's going to be 1.04470, and the left hand side is going to be 1.017. And then you should invest in the Eurozone, not only to take advantage of the appreciation of euro from the lower spot rate to a higher forward rate, but also take advantage of the higher euro interest. Okay, but how exactly to make the trade? There are a lot of steps for you to follow. All right, so since you are an arbitrager and you don't invest the money out of your own pocket, you can borrow the money from a U.S. financial institution and pay the U.S. interest rate, which is lower than the European interest rate. And then 6 months later, you will claim your principal and interest and then convert the money back. So today, you will borrow $5 million and immediately convert it to euros at the current spot rate. So this calculation is provided for you. And then you're going to invest the euros in the European financial institution and begin to make the European interest. But don't forget, simultaneously, you need to enter yourself into a forward contract, which would require you and allow you to sell the euros at the future rate, at the forward rate, which is $1.3. And then what you do, you're going to wait for 6 months until the loan matures, until the forward contract matures at the same time. So when the euro loan matures, you're going to receive not only the principal you invested, but also 2.3% half-year interest. So 2.3 comes from the annual interest of 4.6 divided by 2. All right, and then you're going to convert the euros to US dollars according to the forward rate, which you signed 6 months earlier to get this much of US dollars. And don't forget, when you borrow the US dollar at $5 million, it comes with interest. And that's going to require you to pay 1.7% interest on the $5 million loan. 1.7 is from 3.4% annual rate. Okay, so you will see clearly you make a profit. You will need to return $5,085,000 for the loan you borrow from US. And at the same time, you're gonna receive $5.2 million from the investment in the Eurozone. So that's gonna be a profit. So this is a covered interest arbitrage case. And you can also do some algebra work. So you can convert this equation into US interest, into the US interest minus the euro interest equals to forward premium. Okay, so this is the forward premium, and this is interest differential. Okay, and see whichever is greater. And of course, this forward premium is annualized, and the interest rate is annualized as well. Let's just use the letter A to say it's annualized. Okay, so if the right-hand side is greater, that means the money would be better off to stay in the U.S. Your money is better off to be invested at home than invested overseas. So if that's the case, the U.S. money stays home, then the European money will come into the U.S. because U.S. has higher interest considering both interest and the exchange. And if the right-hand side is greater, then your money, your dollars will be going to the Eurozone or the foreign country to get higher interest. That profit also has the exchange rate being considered. and the European money better stay home to take advantage of the situation. So this is called a covered interest arbitrage. Why do we say it's covered? Because all the interest, all the exchange rates are covered. Okay, these are all locked in rate. There's no uncertainty at all for the forward, for the spot, for the euro interest or the foreign interest or for the home interest. Okay, these are all covered. And why it's called a interest? Because it's mainly due to the interest differentials between two countries. And why do we call it arbitrage? Because there's no risk involved. We just pick up the money on the table.